Evening, everyone. Thank you all for coming. I'm Dick Samuels. I direct the Center for International Studies here at MIT. This evening has an interesting history to it. It came out of a conversation that Barry Posen, colleague of mine in political science here at MIT, and I had back in the summer after the Bear Stearns collapse, but long before the financial meltdown and the global crisis really galvanized people's attention. You know, wouldn't it be useful, we wondered, to hear what smart people had to say about what then was still rather a potential problem. We didn't know, little did we know, what was in store in the area of the topic, the challenge to the global economy. Well, we know more than we did, but clearly not enough. And so we're privileged this afternoon to have two of the nation's leading policy economists, academic economists, who will share with us their understanding of what happened, where we're headed, and what's to be done. I guess it's unfortunate that this couldn't be more timely. Usually you say, fortunately, this couldn't be more timely, but I think, unfortunately, this couldn't be more timely. Martin Feldstein is our main speaker this evening. He's one of the nation's most accomplished and most respected academic and policy economists, a professor of economics at Harvard University, former chairman of the Council for Economic Advisors under President Ronald Reagan, president emeritus of the National Bureau of Economic Research here in Cambridge, and was in the news again this past week when he was named by President Obama to the newly formed Economic Recovery Advisory Board that's chaired by Paul Volcker. Our discussant this evening, the discussant, is Simon Johnson, well known here at MIT. He's the Ronald A. Kurtz Professor of Entrepreneurship here at the Sloan School of Management. Simon served as economic counselor and director of the research department at the International Monetary Fund from March 2007 until last August, and is an expert on the financial sector and economic crises. In addition, he runs baselinescenarios.com, or I'm sorry, no S at the end, baselinescenario.com, a website on the global economy that engages serious thinkers in substantive dialogue about economics, finance, business, and the crisis/recovery. That's the optimistic and pessimistic sides. In any event, Professor Feldstein will speak for about 30 minutes. Professor Johnson will respond for about 10, at which point we're going to open the mics up for your participation in the larger conversation. A warning, though, I am going to run interference for them strictly at 6:45 in order to allow both of them to sprint off to Logan Airport. Both have flights to catch. So I apologize in advance for having to end the evening what I hope won't be too abruptly, but certainly will be earlier than originally planned. So let's begin then. Marty?
Well, thank you very much, Dick. It's really a pleasure to be here, and I welcome this chance in particular to share this platform with my friend Simon Johnson. Let's see if I can put myself back together again here. That seems to do it. Good. Well, certainly there are more than enough challenges facing the global economy for us to talk about. There are so many that it's hard to know where to begin. When I thought about some of the longer-term challenges that we see, maintaining free trade and capital flows, dealing with global warming without reducing economic growth, stopping terrorism, which I regard as an economic as well as a national security problem. But I thought I would focus on the near-term problems. I think there are enough challenges globally in the near term. I'll start by looking at the U.S., and then I will see how it spread from the United States to other countries around the globe. Specifically, I'll look at what's happening in Europe, and then finally I'll look at two major Asian economies, China and India. I don't have to tell this group that the situation in the United States is really very, very bad. We are looking at an extremely deep recession. We're looking at a major financial crisis. It is worse than anything I have seen I think it will be longer and more damaging than any downturn since the 1930s. So I want to look in more detail at the nature of the problem that we face, at what the government is doing and might do going forward, and at the prospects for success of those policies. There's no doubt that this downturn is different from previous ones. The typical post-war economic recession was caused by the Federal Reserve tightening in order to deal with inflation, either an inflation rate that had already gotten too high or an inflation rate that was rising rapidly and that the Fed wanted to nip in the bud. And they did that by pushing up short-term real rates, the overnight Fed funds rate, and doing that until they felt that the economy had slowed enough and the risks of inflation had come down enough, and then they reversed direction, lowered those interest rates, and in so doing brought the economy back up, typically by stimulating housing. Well, this time was totally different. The Fed did not cause this downturn by high short-term interest rates, and so when it finally got around to starting to cut interest rates, and as you know, they've brought down the federal funds rate to zero now, it really didn't have any traction. It really didn't do anything to change domestic demand in the United States, in part because of the dysfunctional character of our financial system and the fact that housing demand itself is in such bad shape. So that's why this downturn is proving to be so much more difficult to deal with than previous economic recessions. We're really facing two quite different problems. They interact with each other, but they are different. One of them is a weakness of aggregate demand, and the second of them is the dysfunctional character of our financial markets. So let me talk about each of them, starting with the drop in aggregate demand. We saw the economy shrink at an annual rate of 5% in the fourth quarter. GDP is forecast to decline at about that same rate in the first quarter. So this is a very sharp decline in economic activity. What is causing this very large hole in our GDP? Essentially two things. The first is the result of the decline in household wealth. Household wealth in the stock market has fallen by some $8 trillion. Household wealth in the form of owner-occupied housing has fallen by about $4 trillion. So between those two, we've got a decline of $12 trillion. Put that in perspective, GDP is less than $15 trillion. So it's an enormous decline. It's a decline approximately 1/3 of total household wealth. So a $12 trillion decline is really an enormous decline, a proportionate decline greater than in previous recessions. Again, I've set aside the depression of the 1930s. What kind of an impact is a $12 trillion fall in household wealth likely to have? Based on historic relationships between changes in household wealth and subsequent changes in consumer spending, we would expect that roughly every dollar of decline in household wealth would reduce consumer spending by about 4 cents. 4 cents this year, 4 cents next year, could carry on like that. So we're talking about $500 billion decline in consumer spending. In addition to that, we have seen a sharp drop in housing starts. Housing starts today are running at about 1/3 of the level that they were at the peak a couple of years ago. So the decline in the number of housing starts about 1.2 million units, and that translates into about $250 billion annual rate. So just those two hits on aggregate demand, the decline in consumer spending and the decline in housing starts, together $750 billion, or about 5% of GDP. Now, the economists among you may say, but isn't that partly offset by automatic stabilizers, the effect on tax collections, the effect on unemployment benefits, and the short answer is no. There's nothing about our tax system or our transfer system that automatically offsets the direct impact of a decline in wealth or a decline in home construction. So it's a very, very large hole. It's a hole equal to 5% of GDP in this direct impact. And if that hole persists, or if policy doesn't fill the entire hole, what happens? Well, then we see second-round effects. Companies not getting orders reduce their production. They reduce their production, they reduce their employment. We saw payroll employment fall by 600,000 in each of the last 2 months. There's a man who got very nervous, and he's leaving to call his broker. The broker's closed. The second round effects are declines in employment, declines in personal incomes, and therefore further declines in consumer spending. So we have an enormous, unprecedented, and likely to grow if we don't do something to close that hole. I'll come back to what is proposed to do to deal with it. But let me say some things first about the dysfunctional credit markets. Basically, the fact that the financial institutions, the banks, private equity firms, and others cannot attract capital in the way they did before and are basically unwilling to make long-term loans to any but the highest quality borrowers. So that small businesses, even relatively large businesses, but not businesses with the highest credit ratings, have a very difficult time getting credit. Why has this happened? Essentially, the problem originated in the mortgage-backed security market. We're seeing a dramatic increase in defaults on mortgages and therefore declines in the value of mortgage-backed securities. And the reason for this is that we had in the residential housing market in this country some dramatic, unprecedented combination of things in recent years. We saw a bubble in house prices that, when it broke, has caused house prices to come down so far by 25%, 18% in the last 12 months, predicted to go on falling by about 15% before we get back to pre-bubble levels. But what's made that so dangerous is that loan-to-value ratios of the mortgages had been pushed up to 90%, in some cases even 100%, before house prices started coming down. And so as a result, what we've seen is that loan-to-value ratios have crashed up through 100%. 1/4 of all homes with mortgages now have mortgages that exceed the value of the home, 1/4 of them. The average loan-to-value ratio among those mortgages is 120%. Individuals in that kind of circumstance have a big incentive to take the keys and send them back to the bank and go off and rent until house prices fall some more and come back, rather than continuing to service mortgages which vastly exceed the value of their home. And that has indeed led to a dramatic increase in loan-to-value ratios and to the fear on the part of financial institutions that much more of that is coming. So they don't know what the value is of their balance sheets. They don't know what the value is of the balance sheets of other institutions. And so they're very conservative about extending credit to other institutions. And since they have to have capital against which on which to base their own lending, if they don't know what the value of their assets are, they don't know what the value of their capital is. And so they don't feel confident about their ability to make loans. And that's why the financial institutions are not lending. And this has all been exacerbated by the dramatic increase in securitization of mortgages during the last 10 years. So what's the government trying to do about it? What will it do, and will it succeed? The Federal Reserve, as I said, drove down short-term interest rates dramatically, didn't do much, and so they have started to do some absolutely unprecedented things, essentially replacing credit that would normally come from private sources. So we have the Fed buying mortgages on a vast scale. We have the Fed backing commercial paper. We have the Fed helping specific institutions. And while it was hard to figure out what Secretary Geithner was saying yesterday, it sounded pretty clear like he had the idea that the Fed might find another $1 trillion to add to its already $2 trillion balance sheet to help a variety of types of asset-backed credit. All of that, I would say, has been moderately helpful. It has stopped a deterioration in the availability of credit to certain borrowers. Where the private markets were not doing it, the Fed was doing it. But it didn't really succeed at all in getting the private markets working, except at the highest quality level and in the very short term. I might add, a lot of people say, is this what the Japanese did? Is this the so-called quantitative easing? And the short answer is no. What the Japanese did was to pour a tremendous amount of liquidity into their banking system, hoping that the banks would lend it out. Here, what the Fed is doing is much more targeted. They are going to particular credit markets, the mortgage market, the commercial paper market, and so on, and providing direct credit in a way that the Bank of Japan did not. So the Fed will undoubtedly do more of this, picking up the slack in the credit market, but I don't see it having the effect of bringing the credit markets back to life, bringing the private markets back to life. So we're in a very awkward situation where the Fed is moving well beyond anything that the central bank has ever done before to act as a credit provider. What about the fiscal side? Well, as you know, the Congress agreed today on an $800+ billion package over 2 years, essentially $400 billion a year for the next 2 years. An enormous package, but you have to compare that to that $750 billion hole per year that I talked about a few minutes ago. So even if every one of those $400 billion added $1 to GDP, it would still not offset the decline in demand, would still not offset the decline in GDP that comes from the collapse of the equity and housing markets and from the decline in housing construction. But unfortunately, certainly to my mind, unfortunately, the structure of this major so-called stimulus package is such that it will not deliver $400 billion a year in additional GDP. It will, I can't be confident of this number, but as I look through the different pieces, I think perhaps 250 or 300 billion a year. So that means that we will have added $800 billion to the national debt in the next 2 years from this source, and that $800 billion will only add about $500 billion to GDP over the 2 years. That is a very inefficient use of national debt capacity. There's a limit to how far we can go. The national debt held by the public, that is not held by the Federal Reserve or the Social Security system, the national debt now is 40% of GDP. It will rise to 50% of GDP in a year, the end of this fiscal year. It'll rise to 60%, probably more than that number because of the policies that are now being discussed. So a dramatic jump in our debt to GDP ratio, and there's just a limit to how far we can go in doing it. So I'm really very worried that we have such a poorly designed program that delivers so little bang for the buck. What about the financial system? The real problem is how to get private sector lending going again, how to fix the balance sheets of the financial institutions. Secretary Paulson talked about buying toxic assets, talked about injecting capital, He talked about providing guarantees. He didn't do any buying of toxic assets. He threw up his hands and said it's too hard. He provided some capital into institutions. But you take a bank like Citigroup with $2 trillion of balance sheet and they put in $25 billion. What was that going to do? Who was that going to persuade that once that $25 billion was there, Citigroup had enough assets that it was a safe bank to which you could lend? I don't mean you and I putting in insured deposits, but wholesale lenders. And similarly, would it convince the management of Citigroup that now that they had that extra $25 billion, they had enough capital to start lending? No. So the complaint that the banks have received this money but haven't lent it out misses the point that it wasn't enough capital to give them confidence in their own availability of capital and the amount of capital that they had so that they could indeed go on lending. Well, Secretary Geithner spoke yesterday, and frankly, what he proposed, one, is not very clear. I mean, he talked in generalities, he talked in big numbers, but he didn't tell us how any of this was going to work. But he did talk about how they would buy toxic assets, how they would provide guarantees, and how they would inject capital. So it doesn't sound fundamentally different, although it has more of a private sector spin to it, less direct action by the government, more guarantees of private action, but the distinction between those two is really not that significant. So I think that the situation in the financial markets doesn't look like it's going to be cured by what the Treasury is currently proposing to do. I think it's very hard to remove enough toxic assets, to remove $500 billion of impaired mortgage-backed securities, $2.5 trillion of impaired mortgage-backed securities containing $500 billion of losses. They've announced that they're going to come out with the final piece of all of this next week, which will deal with the foreclosure problem. That's critical in my mind. If we don't stop the foreclosures, if we don't find a way to stop the inevitable decline in house prices from driving more and more homes into foreclosure, then we're going to see defaults, foreclosures leading to lower house prices further generating more defaults because of an increasing loan-to-value ratio. My bet is they're not going to deal with that problem. My bet is they're going to find a way of helping homeowners who are having trouble with their monthly payments, and they will do some kind of mortgage adjustments. They will help to incentivize financial institutions to do some of those adjustments in order to keep those people in their homes. That's a good thing. It's worth doing, but it doesn't begin to solve the problem. Let me turn from that bleak picture of the United States to say a few things about the rest of the world. We saw a crisis that essentially began in the United States, but quickly spread. Why? Because the fundamental cause of all of this was the underpricing of risk. That was true not just in the United States, but in every major financial center in the world. Once it got recognized in the U.S., it got recognized in London and on the continent and elsewhere. And so that contributed to it. There was an immediate repricing of assets. Stock prices everywhere have fallen. There was an impact, of course, through trade, so that over and above these direct impacts in the countries, there were the impacts that came from outside in the form of reduced trade. And on top of all of that, we're seeing international trade shrinking because as the financial institutions don't have the funds to extend credit, one of the things that's being lost in the process is trade credit around the globe. So the result is a global recession and a mutually reinforcing global recession in that as each country's demand shrinks, it shrinks the demand for imports from other countries, and that just feeds on itself. Let me say a few things about Europe and then about the two major Asian countries that I want to talk about. I think Europe is just waking up to this. They saw the financial crisis early. They did something to fix their banks, but the general economic problem has yet to be tackled in Europe. Industrial production has fallen as fast in Europe as in the United States, and yet they were quite slow to bring down interest rates, and perhaps even more importantly, Europe is not well organized for a fiscal expansion. Fiscal policy expansion by any one European country is going to spill over to all of its neighbors, much more so than in a big single economy like the United States. But there's no way within the European Union to coordinate fiscal policy. And so each country says, well, should I really add a lot to my national debt when much of the advantage of it is going to go to those guys on either side of my border? So we're seeing a much less fiscal expansion. You read the stories in the newspaper, they have tiny little fiscal expansions so far. So I think they face a very serious problem and one that they're not fully addressing. Moreover, I believe that one of the things that will happen over the next few years is that the U.S. dollar will go back to declining relative to other major currencies in the world, including the euro. That was what was happening until 2007, and then we've had a flurry of increase in the value of the dollar. But I think we will continue to see the dollar declining relative to the euro, and that's going to produce problems for the European countries in maintaining exports and in resisting imports. China has slowed. China has slowed to about a 7% growth rate. The unemployment has increased substantially in those industries that manufacture for export for the reasons I've already spoken about. So China is very sensitive to global demand. On the other hand, I really am an optimist about China's ability to come through this process. Their strategy for a number of years has been to find a way to increase consumer spending, to increase government spending on behalf of consumers, the provision of health care and things like that, in order to shrink the share of GDP in China that is going into exports. China now is running a current account surplus of about 10% of GDP. They're exporting, in effect, 10% of their GDP, something that doesn't make a lot of sense for an economy at China's standard of living. While China has grown enormously, grown at a very high rate, the consumer in China has not shared in that growth. Consumer has not shared in it because the saving rate has been going up. So the Chinese officials understand this, and their strategy has been to find ways to shift demand from the export markets to increases in consumer spending. They haven't done it as aggressively in the past, but I think this is going to be a wake-up call for them because the lack of exports is forcing them to see rising unemployment, something they clearly don't like. But it will not be difficult for them to make that transformation because the saving rate in China is about 40% of GDP. And if they reduce that saving rate, that enormous saving rate from 40% to 35%, all other things equal, that will cut their trade surplus in half. That will provide a substantial increase in the domestic demand. So I believe that China, within the next couple of years, will have come out of this in a very healthy way. Finally, about India. India has again shrunk its growth rate. It's still growing at about 6%, which not too many years ago would have been a source of great pride in China, but it has slowed down. And agriculture in China, which is where most of the people live and work, India. Agriculture in India has slowed to a point where there's been essentially no increase over the last year. But the key thing when you think about India is that India, unlike China, unlike Korea, unlike other countries in Asia, is not really tied in to the same extent in the global economy. They're not tied in through exports nearly as much as China or those other countries are. So the slowdown in the global economy is not having nearly as much of an effect on India as it has elsewhere. Moreover, their banking system has been very conservative, so they didn't load up on the same kind of junk that the Europeans, the Japanese, and others bought. So how did they get in trouble? They got in trouble because when food prices and energy prices went up dramatically, they raised interest rates. They did the kind of thing that the Federal Reserve here would have done in the past, but in fact they were fighting imported inflation with a domestic interest rate, and that turned out not to be a good strategy. As you know, oil prices have come down, food prices are no longer rising the way they were, and so that problem solved itself, but the impact of rising interest rates slowed the Indian economy substantially. But they understand that now. They're reducing interest rates. They're picking up their infrastructure spending. So I'm an optimist that the Indians, too, will turn this around and will not be dragged down by whatever slow pace of recovery there is in the rest of the world. Well, let me stop there and let Simon talk for a while, and then I'm delighted to answer questions about anything I've said and maybe about some things I haven't said. Thanks very much.
Thanks very much. And I think my microphone will let me move away from the podium. You can hear me okay. So it's a great honor to be here. It's a great privilege always to speak with Marty. And I'm going to completely agree with him, of course, but also probably be quite a bit more negative about a key dimension of the world economy that Marty, that's right. So when you go back and tell your friends what happened, you say, well, that Marty Feldstein was sort of complicated and pretty upbeat. Simon was very pessimistic. And I'm going to talk to you, I'm going to break what I say very briefly, just to take 10 minutes to talk about three things. Banking, and banking. Now, banking in the United States, banking in Europe, and banking in emerging markets. And all this is going to fit in as ways you'll see with what Marty was saying. Now, before I start, let me say that, as Dick mentioned at the beginning, I was until recently chief economist of the IMF, and one of the jobs of the chief economist is to see what's coming in terms of new ideas and to try and help move official thinking and official consensus around sensible policy. And one way I did this was by having dinner with Marty at regular intervals and finding out what he was thinking, and then going back to the office and pretending they were my ideas. So I would just like to get that out and be very clear to you that I listen very carefully to what Marty says, and I take it seriously. And if I don't understand what he says, and if I don't believe what he says, I go away and I think about it really hard, and I usually almost always come around to his way of thinking. So I'm just filling in the gaps, really, and elaborating on some aspects of what he was saying. Banking in the United States, I think the situation is much worse than what Marty was saying, not because I disagree with him at all on any of the technicalities. I think that's absolutely right, and his diagnosis of the causes and the problems and the effects, completely right. But I think he was a little too polite, partly because maybe we're on video camera and he has an official position now, and I'm not. I run a web. I'm a blogger. Actually, that's my primary. I'm trying to get people to introduce me not as an MIT professor, but as a blogger. Somehow they don't want to do that yet. They still talk about the MIT connection for whatever reason. They think it has more legitimacy. I think the blogosphere has more legitimacy for this sort of thing. And I can say this. The problem in the US banking system is both extremely simple, in my view, from a technical point of view, what you need to do, and incredibly difficult, perhaps even impossible, to solve in the foreseeable future because of the politics. I think that what you need to do, and we can talk about the technical details, and Marty and I would probably disagree about exactly the mechanisms, but I think basically what you have to do is a complete recapitalization of the banking system, which includes a lot of FDIC-type takeovers of failed banks, banks that are actually insolvent if you value their portfolios correctly. It's been done before. It was done by Sweden in the mid-1990s. It is the standard IMF prescription of what to do if you have a failed banking system in a country like Indonesia or Thailand or Korea. We can argue about whether the IMF always says appropriate things in these various countries, of course. But there is a standard way of thinking about what happens if your banking system fails. You reboot the banking system. The taxpayer's on the hook for a lot of money. You kick out the existing management of the banks. I think you start to see why this might be a problem in the United States. And the shareholders lose most of the money, which, by the way, they already did in the U.S. Banking system. And you have to make some hard decisions about bondholders. You'd certainly guarantee all the deposits. And that's it. It's not what some of my colleagues like to call rocket science at MIT. It is very straightforward technically. You can certainly do it in the United States. It's a bit of a shock to realize that we need to be considering this for the United States, and that's why you need to pay close attention to what Marty's saying, and particularly in terms of, and you have to worry also about where housing is going. And if I had more time, I would talk about housing, important things to do in housing that would support this rebooting of the banking system, because if you reboot banking, and then housing goes down another 25%, not 15%, you may have to do it again, which you certainly don't want to do. The key thing is you do this in a way that preserves taxpayer value, and the main way you do that is you're very tough on bankers. Bankers who pay themselves massive bonuses, even when they're receiving a large amount of government support. Bankers who feel that that's an okay thing to do. Bankers who published, the CEO of Goldman Sachs published in Monday's Financial Times an incredible article that you have to go look at. Lloyd Blankfein said, basically, it's business as usual. Crisis, what crisis? We're fine. Don't even think about messing with the banks, is what he said. And this was a piece that was timed to appear the morning when the Treasury Secretary was going to give his big speech about how we were going to deeply change the banking system and really address the causes of the problems. We are in so much trouble politically because of the power of the banking lobby and perhaps the financial lobby more generally, although I think that can be addressed. And on my website, I should say, the website is all about constructive proposals. I am a big believer in not shouting bad things at policymakers, but actually trying to, this comes from my IMF days where shouting doesn't go down very well, particularly if the IMF shouting at you. Try to provide constructive suggestions. Try to explain what are alternative ways to do it. Talk about the comparative experience. That's what the website does. And the website is open to comments, and there is very little ranting on the website. Probably most of it's done by me, about US banks. But seriously, it is a place for people like you to put up comments, to look at the debate, and for interact with people on the outside, and it actually works. That's US banking. The European banking situation is even worse than what I just said. Because not only do they have the problem of the financial lobbies, not only do they have the problem of the big losses, two things. They let their banking systems become really, really big relative to their economies. The Icelandic banking system, at its peak, right before it failed, had bank assets 12 times GDP. Not 12% of GDP, 12 times GDP. It's a problem. It's a problem when the banks fail. And in fact, the Icelandic Prime Minister said one of the most memorable things of the entire crisis back in the fall. I don't know if you remember this one. He said, right when the banks failed, and when it became clear that you had to let the banks default, and then you nationalize them. If you nationalized them before they defaulted, you had a sovereign default, which is even worse. The Prime Minister of Iceland said, we are all going back to fishing. And I think it's actually right. I think that is where Iceland is going. But of course, that's Iceland. Iceland, 12 times GDP. Crazy. Switzerland, banks, assets to GDP, 8 times GDP. The UK, a country that I know a little bit about, bank assets to GDP, 6. Okay? Now, yeah, exactly, right. And that's actually what the US property market, the UK property market is just doing, pretty much that sound, if you heard that from the front row. So yeah, 6 times GDP is okay as long as losses are small. If losses get big, if you've lent a lot to the domestic mortgages, and the housing market does in the UK, actually what it's done in the US, maybe it may even go down more if you look at how much it ran up. You're talking about big losses on bank portfolios that are big relative to GDP. Who's going to? I mean, we're going to more or less, the taxpayer is on the hook for the losses of the financial system in the US. And it could be 10% of GDP if we do it right. It could be 30% of GDP if we do it wrong. Debt to GDP, as Marty said, was 40 to start with. So you're adding between 10 and 30% of debt to the debt to GDP ratio just from the financial cleanup. And that's on top of the fiscal things that Marty talked about and is skeptical about. So you've got about 60 total before you add my banking things. Then you're going to end up between 70 and 90% if I'm doing the numbers right. And then we're going to maybe we'll sort out housing that might be included in those numbers, that might not be. We'll go to, probably when this is done, I would guess between 80 and 90% of GDP debt held by the private sector. That's where a lot of European countries are to start with. Greece has a debt to GDP ratio of over 90. Italy is a little bit under 90. This is before they do their financial system cleanups. And they have the messed up, the problematic, sorry, technical term, the difficulties of fiscal policy coordination that Marty articulated. Actually, I don't even think they can do fiscal stimulus in some of these European countries. I think they have to worry about fiscal consolidation, fiscal austerity, and that's the view of the bond market also, of Greece and Italy, and increasingly worrying about some of the other countries. So banking is bad in the US because of the politics. It's easy to do it. You know what should be done. We can afford it, but the politics are horrible. In Europe, the politics are terrible. They're in denial, as Marty said, and they can't afford it. They actually can't afford it to do the right thing. So then you're talking about banks defaulting, and this is Icelandic fishing scenario. Okay. The third set of banks, just in 2 minutes, is emerging markets. So the lesson that most emerging markets took from the last big crisis, the so-called Asian crisis, but of course it was much broader, 97, 98, was, we must carry large amounts of reserves. We must try to run current account surpluses. This is the China point, Martin. China did this to a degree that's never been seen in the history of mankind, but most other emerging markets tried to do the same thing. And let me talk about Russia for a minute, a country I also know quite well. So they started the crisis with about, if you believe the numbers, about $600 billion in reserves. That's a huge amount of reserves. That is more reserves than anybody else has ever had, apart from China. And Japan has a lot of reserves for other reasons. And they thought that, and they ran a very, by the way, a very conservative fiscal policy in Russia. Okay? The fiscal balance of Russia all depends on energy prices, but they did not go, there's not a massive overspending by the government story. What happened? Well, they let the private sector go out and borrow a lot of money. The private sector was financed, of course, by the same banks that got the US into trouble and the Europeans in trouble. I mean, it's a whole big financial oligarchy conspiracy. You know that. But anyway, we'll leave that to one side. Anyway, the emerging markets like Russia borrowed, roughly speaking, about the same, or not the case of China, but in the case of Russia, in the case of Korea, in the case of other emerging markets, they actually have foreign debt in excess of their reserves. Now, you know, a lot of people thought this was going to be fine. In the conditions that Marty described, in this synchronized global downturn, energy prices collapse, your other exports collapse, capital flows collapse. You know, you still have $600 billion with reserves. What do? Well, you support the currency, and then you lose some reserves. And you get to the Russian situation now. They have $380 billion in reserves. And they still have foreign debt out there. I mean, when you go into a crisis, you find out your reserves are lower than you thought they were, and your foreign debt is higher. So they now have foreign debt of about $500 billion, as far as we know. It's probably higher. Now, $500 billion in debt. It doesn't all come due tomorrow, so perhaps you're right. Well, you are right unless everybody decides they want to hedge those positions. If they want to go out and buy the dollars to cover so they're not short dollars anymore, then you have a big problem. Then you don't have enough reserves. Then you have a colossal run on your currency. And you have to decide, this is what the Russians are deciding right now, which of their powerful people get bailed out, which of them do you give dollars to, which of them let them cover the position, and which ones default. And I think, while the Europeans are largely in denial, a lot of the emerging markets are still in denial. Oh, and we do have, in conclusion, of course, we do have the IMF, the great IMF. And the great IMF, the IMF of which you've heard so much, the IMF of all the stories that you were brought up on, no doubt, about crises. The IMF has total loanable resources at this moment of $250 billion. Now, that's billion with a B, not trillion with a T. Right? So we're in a hole in our bank system for $1 trillion. The Europeans are out there. We're talking trillions. The emerging markets, just Russia, has got we're talking about 500 billion type of hole in the banking system, probably. The IMF has 250 billion. It wasn't modernized since late spring of 1945, and they barely increased the capital. It's fallen massively behind. There's not much going to do about it. They have a proposal on the table. They've asked to double their resources. Big shock, big news this week. Managing director of the IMF says that we're in a serious crisis. Yes, I know, yes. Well, anyway, we won't talk about that. But, and he needs to double the lending resources of the IMF to 500 billion. Well, it's a good idea. It's way too late. It's not enough money. It's not. And what are you going to do? You're going to lend money to Russia so they can bail out their corporates that have this massive amount of foreign debt? Of course not. The politics of that are just way too horrible. So it all comes back to, just to end on a positive note, I'm trying to find one. It all comes back to listening to Marty. You have to think about U.S. policy. You've got to think about how you try and turn the corner on the U.S. And I think I mean, I am very preoccupied with banking because that's been a lot of the debate in Washington. I do think Marty's points about housing are incredibly important. And unless and until the U.S. turns the corner, I don't think the world turns the corner. And I've been saying for some time, something that a lot of my colleagues thought was a little too extreme. But I heard President Obama say it on Monday night. So, the consensus on these things moves quite quickly under these situations. There's a danger we could lose a decade. Japan lost a decade of growth in the 1990s for exactly the same sort of reasons Marty was outlining. The big fall in wealth, anemic consumer spending. Also, firms wanted to pay down debt, rebuild their balance sheets. And that meant slow growth, or basically no growth, despite having a strong export sector because they had an undervalued yen and were able to keep exports strong throughout the year. We cannot have a strong export sector at the global level. We don't get to export to Mars, right? So it's a closed economy at the global level. And what Marty's saying about this fall in household spending, fall in wealth, fall in household spending, fall in investment, and I think perhaps even an increase in desired saving, maybe, in many places, this is global. This is synchronized. And we have very few policy tools to deal with it. There is a real danger, I think, unless we get the U.S. situation really turned around, which includes a much better approach to banking, which is very hard politically, and it includes housing, and it includes, hopefully, improving what we do fiscally, and I think it includes more progress on monetary policy that Marty didn't have a chance to talk about, but you can hopefully ask him questions about. Unless we do that, we could lose a decade at the global level very easily. A decade slips away just like that. The Japanese tried a few things. They built some bridges to nowhere. 10 years go by. That could happen to us at the world level. Thank you. I forgot the positive note. I was searching for a positive note there.
Okay. Great. Well, I'd be happy to try to answer questions. Yes?
You mentioned that you thought the stimulus package wasn't as effective as it could be. So what would be like an alternative stimulus package? What changes would you?
Yeah. Well, I don't want to get into too much detail about the stimulus package, but let me give you a sense of why I think the stimulus package was not as effective as it might be. And let me preface it by saying I surprised a number of my friends by saying I thought a fiscal stimulus was a good thing, a thing that needed to be done. I found it painful to say so because I have spent years talking about the disadvantages of large fiscal deficits, the reasons why government spending is a less useful way in many, many cases of spending resources than letting individuals do it. But my sense is that in the current situation, savings are going to rise, consumer spending is going to fall for the reasons I indicated, and so the government has to start filling in that very big hole. So one thing they have, a major piece, just take two things. A major piece of the bill that's just passed is a tax cut for individuals. And the form of that tax cut is to give everybody who works $500 a year for 2 years. It's very similar to what happened in 2008 when we had a fiscal rebate, which that happened once in 1 year as opposed to 2 years, but it was a one-shot thing. And what we now know is that most of that money was not spent. Most of it didn't add to aggregate demand. Instead, it went into savings or paying down debt. More than 80% of it was not spent by the households that got that money. So we're going to make that mistake again, and we're going to add $150 billion to the national debt and perhaps get $25 or $30 billion of additional GDP. So I think that while there can be a role for changing taxes, it should be designed to stimulate spending rather than to simply give people money and hope that they will do so. The British, who have a value-added tax, essentially a national sales tax, have said they're going to cut back the value-added tax by 2.5 percentage points. And the estimates that their economists make is that for every dollar, every British pound that they lose in revenue, there will be a $1 increase in GDP. So we ought to ask ourselves, it's a little trickier here because we don't have a value-added tax, but we could have explicit spending incentives for consumer durables, for home improvements, for automobiles, and so on, which I think would be a more cost-effective, and for business investment, be a more cost-effective way of making the tax change. On the spending side, there's about $200 billion of money that goes with no restrictions at all to the governors. Governors are nice people. I'm sure they have good intentions, but wouldn't it be nice to know what they're going to do with that money? Recently, we read in the paper that governors in many states are saying, what we want to do is to pay businesses to come and locate in our state and create jobs. Now, for each governor, that's a sensible thing, but collectively, zero. It's a zero-sum game. So I think they ought to say any governor who does something like that shouldn't get any money at all. They should be required. This is going to go through. It's gone. I mean, that bill is there. But as you gathered from the arithmetic that I talked about, it's not going to do the job. It's not going to fill a $750 billion hole. So the bad news is we're going to be back again talking about stimulus package number 2 on a large scale. And my hope is that they will design the tax part of it and the spending parts of it with much more focus. Here they had to rush something through, and what we got was more stuff that the folks in Congress like, stuff that the governors like, and less of a targeted incentive to increase GDP. Over here, yes. Inflation. Well, of course, right now the big worry at the Fed is deflation. So they're talking about the fact that the inflation rate is now approximately 0. But I think you're on the right side of that debate in worrying about inflation. I don't know if everybody could hear, but no, okay, sorry. There's a microphone there. Why don't you repeat your question? And then I'll repeat my answer.
Yeah, the question was, do you think the US will see the desired level of inflation come out of current monetary policy stance, and when do you think that might happen?
I think we will go through the desired rate of inflation is about 2%. I think at some point, not too far into the future, we will go through the desired rate and keep going. Now, why? The Fed does have this enormous balance sheet. Instead of $100 billion of assets on its balance sheet, it now has $2 trillion, and if we're to believe Tim Geithner, on its way to $3 trillion, maybe more. What that means is that the banks have enormous reserves which could be used to create increases in the money supply if they chose to do so. Just to give you an example, the so-called free reserves of the banking system normally run a quite small number, are up now at the end of last year, we're up well over $500 billion. So there's a potential there. Now, can the Fed control it? Can the Fed wind back all this stuff? Yes. Will they get it right? Maybe. So there is that technical risk. But what worries me more is the political risk that with a very slow recovery, because as Simon said, the savings rate is likely to keep going up. We had negative savings in the household sector a couple of years ago. The most recent read on that number was 3.6%. It could easily go back to the near double-digit levels that we had in the early 1990s. So that will slow down whatever expansion we're able to get as consumers prefer to rebuild the wealth they lost rather than to go out and spend. Now think about the political process saying, where's the growth? Have we lost the decade? Why isn't the Fed doing more? Lowering interest rates. Don't worry so much about inflation. Get on with it. So that's the danger. That's the danger. It's not a sure thing, but it is a danger that in a slow-growing recovery, they will be more concerned about trying to get the unemployment rate down faster and less concerned about inflation. Yes, sir.
Could
Could you say something about reasonable ways?
Here, she's got a microphone for you.
Could you say something about reasonable ways or reasonable schemes to clean up the bank's balance sheets? And we heard one proposal here that just says totally recapitalize, which I take it to mean implies nationalization of some kind. And then we hear kind of this rather incoherent and vague scheme out of Geithner that I don't know what it means. And so I'm kind of confused about this. So I'd be interested in anything you could say.
Well, I mean, a lot of people say really the banks are insolvent. A lot of people who are well-informed say the banks are insolvent, so at some point we're going to have to totally recapitalize them. In effect, it may be nationalizing them and then turning around and reprivatizing them. That's not the direction I'd like to see us go. I think I know what can be done about the most unusual form of problem they have, which is the mortgages and the mortgage-backed securities. But as this economy gets into deeper and deeper trouble, we have more problems for commercial real estate and more problems for commercial loans and so on. But let's talk about the part that makes this unusual, and that is the mortgage-backed securities. Because the mortgage-backed securities have this peculiar property that even if you could scoop them all up and take them off the balance sheets and stick them in some public bad bank, new ones would happen the next day. Because as house prices come down, people who today have positive equity in their home would see themselves with negative equity. And at some point, they'd start defaulting, and that would drive prices down more. And so that doesn't work, in my judgment. So you can't stop the house prices from coming down. They have further to fall to get back to any kind of a sustainable level. So what would I do? It's easy to see what to do, I believe, about the folks who today have positive equity in their home, people who today, and that's 3/4 of all the mortgages, what to do to prevent the declines in house prices from pushing them into negative equity. What I would do is have the government offer a loan to those people, a loan which would be used automatically to pay down 1/5 of their mortgage. It would be a very low interest loan, would essentially pass through the government's cost of funds, roughly 2%. So these mortgage replacement loans would replace 1/5 of the existing mortgage. So if you have a mortgage which is 90% of the value of your home, we will induce you to take on this nice new loan, which will reduce your mortgage from 90% to 80% of 90% or 72%. It'll be a good deal for you in that you will have a lower interest rate, probably even a longer repayment period, but it will be a loan with full recourse. The thing that is unusual about the United States, as far as I can tell in the entire world, is that our mortgage loans have no recourse. And even in those states where there is some opportunity, what that means is that if an individual defaults on a mortgage, the creditor can take the property, but generally can't pursue beyond the property to other assets or to the income of an individual. That's not the way it works in other countries. Moreover, even in those states where the creditor in principle has the right to go after assets or income, the personal bankruptcy laws are so lax or so borrower-friendly in the United States in comparison to France, England, Canada, that the creditors don't even bother to try. So we've got to get people to have some skin in the game, some reason not to do it. And if you're at 90% and house prices are going to fall some more, then we've got to give you an incentive not to do it. And my way of doing it is to build this firewall by replacing 1/5 of your mortgage. You still owe the same amount. Your monthly payments are lower. That's the bait to do this. But house prices could fall, in the case I just described, by another 28% before you'd cross the border into negative equity. So that takes care of 3/4. What do we do about the ones who are underwater now? There's no easy answer, but it doesn't take trillions. The total amount, there are 12 million mortgages underwater. 12 million mortgages. The typical mortgage is about $200,000. It's about $2.5 trillion worth of mortgages underwater. The amount that they're underwater these days is about 20%. So multiply all that out, and you've got $500 billion of underwaterness, if that's a word. So you have $500 billion that you would have to eliminate, debt you'd have to eliminate to get all of those homes back up to par, back up to a point where the loan-to-value ratio was 1. So I think that the government and the creditors should find a way to get together, and the government saying, we will bribe you to take some of that hit. If you're a creditor with a guy who's got a mortgage that's 30% underwater, you've got a guy who's going to walk away sometime soon. And if he doesn't walk away now, when house prices come down another 10%, he's that much more likely to walk away. So I've now made you a creditor. You, the creditor, have a strong incentive to want to settle for less than losing the full amount that you're underwater. So if it's $50,000 underwater on this mortgage, maybe you do 25, the government does 25. Then I come along with my mortgage replacement loan for that homeowner, so that what you have when the dust settles is a guy who has 20% equity in his home and is therefore very unlikely to default in the future. So that's what I would do. How much would it cost? Well, $500 billion was the total amount underwater. If you could get the creditors to do it for, on a 50-50 split, $250 billion. That used to be a lot of money. But not in the age of the TARP and all that. So I think that is what I would do. Now, what that would do would be to take away the recurring problem, the problem that keeps coming back at you as house prices come down. There would still be the problems associated with commercial real estate and ordinary loans and so on, but those are ordinary problems of the business cycle. They're going to be worse this time. And of course, asking these banks to give up half of their, that piece, in some cases is going to make those banks insolvent. And in order to do that, the government is going to have to say to them, if you will do this, and that pushes your level of capital below some level, we, the government, will come along and invest capital. We'll invest, whether you like it or not. We will take partial ownership of your bank through, I would hope, preferred stock rather than common stock. That's a long answer, but it's an answer I like giving, because I think that is the missing piece, and it's going to be missing again next week. They're going to figure out how to help some individuals who are having a hard time with their monthly payments, but they're not going to deal with this key problem which really hangs over the financial institutions. So thank you for giving me that opportunity. Yes.
Sure. Simon Johnson referred to a problem of leakage that would create disincentives for states to assume additional obligations while stimulating. I want to actually ask, if we go back to... or
that was
this,
me. It was me. I did it. I said it. But
if we look at this problem, the standard solution to that is something called coordinated reflation. Right. In fact, that old program, the Coordinated Reflation Action Program, with the most unfortunate acronym in the history of public policy. The question here is that when you look to the economics and the politics internationally on macroeconomic coordination, do you actually believe that we will see the coordination necessary to reflate together? And if we cannot, what are the consequences, both in terms of growth, emerging domestic constraints, and monetary, the fate of the dollar?
Well, I think it is primarily a problem in Europe, where the cross-trade issues are so important. And they, in principle, should have a mechanism. I mean, they have the ECOFIN, the Economic and Finance Ministers Council, and they have bodies for doing it. But they also, and so they have a way to meet, they just have to do it. I mean, I don't have any magic formula for getting them to do that, but I think they have to recognize that there is this problem. They have to say, we all understand about the Stability and Growth Pact, but we're going to suspend that for now, and we're going to say that if Germany will do this much, then France will, and then others will come along.
They have to, but if they do not, What are the consequences?
Well, the consequences are that they will continue to have a very weak European economy. I don't think there's much doubt about that. You know, as I've made clear, I believe that fiscal policy can be helpful, and well-designed fiscal policy can be more helpful. But there are people who disagree. People who would say, Simon made the point that the debt levels are already very high in Europe. So, and Trichet has said, you know, the danger is if we push up our debt levels, we may undermine confidence. And he didn't mean financial confidence in the euro. He meant confidence in the public as they see their debts go up. And I suppose if I pursued that argument, I'd say, well, if you're starting at 70 or 80% and you're talking about adding substantial amounts of debt, then people may begin to say, whoa, how are we going to pay for that debt? How are we going to service that debt? Our tax rates are already much higher than those funny people over across the Atlantic. So that's going to push our tax rates up, or we're going to have inflation. And either way, we don't like it. So people are going to be depressed, and they may say, well, I don't know, we'll take our money and go buy gold bars because that'll protect us, but that doesn't do a heck of a lot for the economy. So they can talk themselves into an inability to gain through an expansionary fiscal policy. That's pretty gruesome. That's a more negative. Now I've topped you in negativeness, right? Yes. Okay. Yes, sir. Wait, there's a microphone that has to come to you. Or you to the microphone.
Just returning for a second to your description of how the government could perhaps deal effectively with the mortgage by cooperating, if you want to call it that, with the banking sector and taking a 50% hit. To make it more politically palatable, is there any way that the politicians could be encouraged to think that that $250 billion, say, or some large number, could be recovered in 5 or 10 years? Is there any guarantee that would make the whole thing saleable?
I don't think so. People talk about providing some shared appreciation, meaning that as part of the terms of doing all this, the homeowner would have to agree that when the homeowner sells his house in the future, some share of that would go to the taxpayers. Well, I assume he would sell the house the next week. So there wouldn't be any appreciation, and then he'd go buy another house. So you may be able to trap him into it for a while, but I just don't see a way of doing it. I think that there are going to be a lot of bad political vibes associated with whatever we do, whether it's helping the banks or helping the homeowners. You know, why should we help that homeowner but not you? I don't know how to get around that, but it's like the question over there. If we don't get around it, I don't see how we fix our banking system. So we can't just let house prices continue to spiral down, and that, I think, is unfortunately the path that we're currently on. I think we have time for maybe one more. Yes, sir. Wait, if we can get you this microphone. So that...
So making zombie banks out of Citi, B of A, others, it doesn't seem is going to get us out of this in the longer term. And basically, at some point, pain needs to be taken in that sector. So my question is, what kind of indication should we see, or do we see from the administration that maybe that's something they get, and that's something they might act on in terms of policy?
I don't think we saw that in Tim Geithner's remarks. He did talk about stress testing the banks, seeing if they have enough capital now to take whatever kinds of shocks are likely to come along as the economy goes down. So that could lead to the conclusion that some of these banks have so much high-risk assets on their books that they're just not solvent, and that they're going to have to be, in effect, taken over. And so that process of doing that stress testing may be the way in which some of these banks ultimately are forced to be taken over and nationalized. Or alternatively, it may be that private creditors will come to be so nervous that these banks won't be able to fund themselves without the government providing the funds, and at that point the government may say, well, the game is up for you. But that doesn't really solve the problem for the system as a whole, in my judgment. We have time for one more. Yes, fine.
I was wondering, nobody's talking about how did we get into this situation. Why did we allow banks with $3 in reserves to gamble on a stock market with $97?
We shouldn't have. There are people whose job it is to not let that happen, and they didn't do their job. Those people are called bank supervisors. I don't think we need dramatic new regulations, but I do think the bank supervisors, it's the Fed, it's the controller of the currency, which is part of the Treasury Department, it's the state banking supervisors. They have two major things to look at. One is the adequacy of capital. Is there enough capital? And the other is the quality of the assets. And they failed on both of those. They thought there was enough capital, but they didn't count lots of this off-balance sheet stuff. And there would have been enough capital, apart from that, if the quality of the assets had been good. But they allowed themselves to be fooled by the rating agencies' statements that some of these very highly leveraged mortgage-backed securities were, quote, AAA, even though the underlying assets were pretty junky. And that was based on looking at a recent history of what happened to mortgage defaults during a period in which house prices were exploding in a very positive way, unemployment was going down, so those securities had very low risk. But they extrapolated that then into the future, and once things turned around, it turned out that was all wrong. So they did a very poor job as banking supervisors. So I think you put your finger on a very important point.
Thanks, Marty. So I have three requests of everyone. Well, first is to thank our speakers for their presentations. The second is that you not get in their way as they sprint to the airport. And the third is that you stick around for some refreshments, which are outside. Thank you all very much for coming.